Welcome to the Accounting Times channel. The mission of the main channel is to inform accountants about the most important issues in the accounting and auditing profession. Please like and subscribe to the channel to receive all the contents. The most common and tricky job interview questions for accountants and auditors. Let's start. The first question. What is working capital? And why is negative sometimes? This question is tricky because when you think of working capital, the equation is current assets minus current liabilities. And so the reason why it goes negative, and it's not a bad thing, it's actually a good thing, because when it goes negative it signals to the efficiency of the business. And let me explain what that means. When the working capital is negative, first the formula of working capital is current assets minus current liabilities. What goes into current assets? Cash, accounts receivable, and other liquid investments. What goes into current liabilities? Accounts payable, and other accrued expenses. When current liabilities is bigger than current assets, you have a negative working capital. It's signaling that you are collecting your accounts receivable faster than you are paying your accounts payable, meaning your operation is efficient in the way that you are invoicing and collecting cash fast, making accounts receivable small. And you are actually able to negotiate better terms with your vendor to push these payment into future, and have a higher accounts payable. So it's not necessarily a bad thing. This is why you have a negative working capital. Second question. What is the impact on income if inventory goes up by $15? The answer is that nothing. When you buy inventory, you are not impacting income. All you are doing is debiting inventory $15 and crediting accounts payable or cash for $15. That means zero impact on P&L. The third question. Where do you see dividends on the income statement? This question is sort of tricky because the interviewer is trying to gauge your understanding of the financial statement. Dividends don't typically go on income statement because dividend payout is not expense, so you don't see it in the income statement. Because dividends not expense. What they are? Distribution of the company has been accumulating profits throughout the years. And they are now just distributing some of that profit to the shareholders, and so its reduction to equity, it goes in the shareholders' statement and nothing in the income statement, and so this is sort of a tricky question. But remember that dividends are not an expense. They are distribution of the equity or distribution of the profit that the company has been accumulating. And that is the answer.
Most frequently asked accounting interview questions.
The fourth question.
If you have only one financial statement to choose, which financial statement would you choose to give you the most information on the business? We have heard this question before. And the answer is statement of cash flows. The reason is, if you look at the P&L statement alone, you will not be able to tell what is the cash position or the debt the company carries. If you look at the balance sheet alone, you can tell what the cash position is or what the debt position is, but you cannot tell the actual health of the performance in terms of P&L. If you look at the cash flows, it really has all information you need, because it begins with net income and then it goes on detail cash from operating activities. And then it goes on to the section of cash from investing activities. And the cash from financing activities. So, you can tell the P&L by looking at the net income right on top. You can tell the ending cash by looking at the bottom of the sheet. You can tell the movement in the balance sheet accounts in the operating section. You can also look at the investing section and find out what the company is investing in terms of capex. Financing section is going to tell you what debt the company raised, what the debt the company has paid of, and also what interest was paid or received. So the cash flow statement is the answer to the most important financial statement.
The fifth question. Do you think there is any difference between inactive and dormant accounts? Yes, both are different terms in accounting. Inactive accounts mean that accounts have been closed and will not be used in the future as well. While dormant accounts are those that are not functional today but may be used in the future. Sixth question. How can you explain the basic accounting equation? We know that accounting is all about assets, liabilities, and capital. Therefore, the accounting equation is assets equals liabilities plus owner's equity. Seventh question. When do you buy CIF and when do you buy FOB? CIF is considered a better way to buy goods for those who are new to international trade. It might also be a better option for new traders who have small cargoes. In CIF, the seller is responsible for transporting goods to the nearest port, loading the goods on the ship and paying freight for the goods to be delivered to a port chosen by the buyer. The seller is also responsible for paying insurance for the goods. FOB. It is better to buy FOB for those who are already familiar with international trade. These traders have their own forwarding agents and logistic agents in place at the port where the buyer loads the goods to be imported. In FOB trading, the seller is only responsible for taking the goods to the nearest port on his or her end. This location is indicated after FOB, and it is important to accountants, as goods become assets to the buyer on the day they reach that location. The goods are considered delivered once they cross the ship's rail. The buyer is therefore responsible for paying the ship's freight and insurance. The advantage of buying FOB is that the buyer can get better deals on freight services, unlike in CIF, where the buyer has to rely on the freight services chosen by the seller. This is because the seller might be looking to make profit from the freight services. The buyer therefore makes profit from buying FOB. Eighth question. What is break-even analysis? Break-even analysis in economics, business, and cost accounting refers to the point at which total costs and total revenue are equal. A break-even point analysis is used to determine the number of units or dollars of revenue needed to cover total costs, fixed and variable costs. What is the break-even analysis formula? The formula for break-even analysis is as follows. Break-even quantity equals fixed costs / sales price per unit, variable cost per unit. Where fixed costs are costs that do not change with varying output, example, salary, rent, building machinery. Sales price per unit is the selling price per unit. Variable cost per unit is the variable cost incurred to create a unit. It is also helpful to note that the sales price per unit minus variable cost per unit is the contribution margin per unit. For example, if a book selling price is $100 and its variable costs are $5 to make the book, $95 is the contribution margin per unit and contributes to offsetting the fixed costs. Question number 9. What's the difference between deferred revenue and accounts receivable? Deferred revenue represents cash received from customers for services or goods not yet provided. Accounts receivable represents cash due from customers for goods/services already provided. If cash collected from customers is not yet recorded as revenue, what happens to it? It usually goes into deferred revenue on the balance sheet as a liability if the revenue has not been earned yet. Question number 10. How does an inventory write-down affect the three statements? On the balance sheet, the asset account of inventory is reduced by the amount of the write-down, and so is shareholders' equity. The income statement recognizes an expense in either COGS or a separate line item for the amount of the write-down, reducing net income. On the cash flow statement, the write-down is added back to operating cash flows as it's a non-cash expense, but it must not be double-counted when calculating the changes in non-cash working capital.